In this example, we're going to use the present value tables in the back of your book, Appendix B, to calculate the issue price of a $300,000 bond issue for each of the following independent cases. And we are to assume that interest is paid semi-annually, which means twice a year. So in the first example, we're looking at a 10-year 8% bond issue, and the market interest rate is 10%. So we have to pay attention to these amounts here. The fact that this is a 10-year means it pays twice a year, so we're going to actually have 20 interest payments. The 8% bond issue, that's the face amount on the bond. That's the amount that's going to be used to calculate interest paid. And then the market interest rate of an annual 10% is what we use in the table. But since that 10% is an annual rate, when we go to the table, we'll actually use 5% for half of the year and 20 periods. So first we need to calculate our interest. That's not given to us here. So we have a bond issue of $300,000 times our face rate, which is the 8%, gives us $24,000 annual interest. But keep in mind that we're paying interest semi-annually, so twice a year. So if we split the $24,000 up over 2 times for the year, we're going to have $12,000 in semi-annual interest payments. So then we need to calculate, like we did in previous assignments, the present value for the interest and then the present value for the lump sum, the $300,000. So from the present value table, using 20 periods, because it's 10 years, twice a year, and payments of 5% because the 10% market rate is for the whole year. So 5% will be for the first payment, and then the other 5% will be for the second payment. So we take our $12,000 interest times the factor we get from Table 2, 12.462, and then we use the present value of a single payment of the lump sum. Keep in mind the lump sum, we use Table 1. So we have 20 periods at 5% also, so 300,000 times the factor 0.377. And we get an issue price, total present value of the bond issue under these circumstances, 10-year, 8% face rate, and 10% market rate, gives us the bond issue of $262,644. Now let's look what happened when things change a little bit. So for B, we're going to still have a 10-year, and we're still going to have the 8% bond issue, but the market interest rate is going to change. So our factors from the appendix are what are going to change. So we still have our interest, 8% face rate, so we still have $12,000 in interest paid semi-annually. But then when we look at Part B here, we're going to compare it to Part A. We still have the $12,000, but our factor has now changed because we now have 3%. We went from a 10% market rate to a 6% market rate. So 3% and 20 periods are what we're going to use from Table 2. So that changes our factor to 4.878. So then using the present value of the lump sum, we still have the $300,000 is the amount of the bond. And then again, we changed to 3% because the market rate went to 6% from 10%. So you can see how things change a little bit. Then we go to Part C, a 10-year 6% bond issue with a market interest rate of 8%. So we still have 10 years, but now our bond issue amount, we went to 10%. So now our interest amount is going to be a little bit different. So now we're going to take the $300,000 times the 10%, which gives us $30,000 annual interest rate, which divided by 2, because we're paying semi-annual, is $15,000. So we look at things that have changed here for Part C. Well, our interest amount has changed because the face interest rate, our bond issue amount, went from 8% to 10%. And then the market interest rate is now 8%, which is what we use for our table. So half that is 4%. So we go to our table, and we have 20 periods, 4%, so we get a factor of 13.59 times our $15,000. And then also from Table 1, we now have 20 periods and 3%. So then let's look at what happens for D. Now we've increased to 20 years. We went from 10 years to 20 years. Our face rate, the bond rate, is 10% and the market rate is 12%. So let's look at what happens. Our interest is still $15,000, $300,000 times our 10% face rate, divided by 2 because it's semi-annual. And then let's look all the way down here what's happened. Now we have used 40 periodic payments because we went to a 20-year, twice a year means we're going to pay interest 40 times. And we're going to use 6% because our market interest rate has now gone all the way up to 12%. So half of that, 6% for the first period and then 6% for the second period of paying interest. So we still have $15,000 for interest times our factor from table 2 with 40 and 6% is 15.046. Then for our single payment, our lump sum amount from table 1, we use 40 periods and 6% again.